All right. We are live, and I am here once again with Amit from Qapita. Amit, for those of you who aren't rabid fans of our monthly podcast, could you give us a little bit of an intro of who you are and what Qapita does?
Yeah, thanks, Charlie. Good to see you again, and I appreciate you hosting these sessions regularly. My name is Amit. I lead the equity management practice at Capita. So we are a company that supports other organizations in managing their equity ownership. So ranging from everything from cap tables to equity compensation, design, structuring, administration, relations, financial reporting. So now we'll be covering a few aspects in relation to employee equity today. So looking forward to our chat.
Cool. So Capita started outside the US and now has a global reach. And you guys have employees around the world. And more often, and particularly post pandemic, startup companies have employees
Yep.
around the world, which means that they're operating across jurisdictions. You've got some instances where you've got companies in the US that are hiring people who are native to other countries.
Yep.
You've got US expats who are, decided to live out their dream and go work around the world remotely for US companies. You've got all sorts of combinations. You've got companies outside the US that are hiring here and expanding. Just what's the one big assumption? Let's just start with the US founders in thinking about how they can have their employees around the world participate. What's the big assumption that they're probably going to get wrong just to open up?
Yeah, for sure. And I think you kind of alluded to like we've experienced it ourselves as an organization, as Capita. I personally experienced it. I'm an expat myself. I moved around and lived and worked in different countries. So what you kind of learn the more you do work in this area is that things work differently everywhere. So I think that one big assumption, one key mistake a lot of organizations and founders can make is that whatever we set up based on our existing setup, where our company is incorporated, will work elsewhere. That may be true. Actually, there's a lot of other jurisdictions may follow similar structure and different award types and design of your incentive program can work cross borders, but a lot more times it's actually not the case. You might need to be a little bit more nuanced and localize things as well. So I think that there's a perception of maybe comfort is that you can work with a really good law firm, put all the right documents in place and be kind of prepared for the now and the near future. But as we know that in business things change, you never know where your company is going to grow and progress. There could be organic growth, could be inorganic growth. You may be acquiring businesses with employees in different jurisdictions. And you may not be fully prepared for the nuances that come into play in incentivizing and rewarding employees in different countries. So you can get messy. So I think it's important to do that homework and always check before you make decisions of offering equity in abroad.
So you get to see this on the back end
Mm,
across hundreds of companies. When I, as a US founder, extend an offer to somebody who is working abroad,
yeah.
what tends to break first? Is it that I'm not doing the paperwork right? Is it
Yeah.
sort of on the back end where it turns out there are tax issues that I didn't foresee?
Mm.
Is the actual instrument the wrong thing? Like, where does this fail?
Uh, yeah, correct. So getting the paperwork right, drafting your plan, making sure that's all approved, but board shareholder, that's important. I think the key break is not understanding the implications for employees and the employer, which is your company. So for employees' perspective, and I think the key one you need to think about is taxation. What does it mean? How would equity be taxed? When? Because the trigger for taxation may be different in different jurisdictions. And sometimes, employees may not be aware what they're getting themselves into. So do they have the full understanding of how the plan works, what they're being offered? Maybe the design of the plan is a little bit different to what they're used to in their specific market. I think that's important to kind of keep in mind. And obviously for the company, you also need to understand, there's usually different buckets that impact what you're supposed to do. So securities law, can you actually even offer equity in that jurisdiction? Or if you do, are they like filing requirements, registration, exemptions you have to apply? How does the tax work?
Are there places that can't offer equity?
I think there are places that make it either very hard or practically impossible to offer equity for
Interesting.
sure, for various reasons. So one of the common reasons is exchange controls. In some jurisdictions, countries, it's pretty easy to move money, funds in and out. For certain jurisdictions, there are certain restrictions in terms of how you can transfer the funds into the country, it's transferred out. So why is this relevant in the context of equity? Is that if you are foreign in the context of that jurisdiction registered company and you're looking to, for example, cash people out and pay them the proceeds for selling their shares, right? How is that money going to enter the country and be actually paid out to the individuals? Or if you want to give options to employees in different jurisdictions, they usually have to pay an option cost. So that's strike price per option. So those funds have to go from the employee to the company. And if it's a foreign company, how's it actually going to work? So there's a couple like famous examples where equity is tricky. So for that reason, a lot of people may need to go down the path of alternative designs and structures, like maybe like phantom shares or like other cash settled plans instead.
Gotcha. And I mean, the moment you start talking about phantom shares and
Mm,
paperwork and all of this sort of stuff,
mm.
it sounds expensive, but maybe this has all been done before, and it's just a matter of knowing what to do ahead of time. Is it cost prohibitive to layer on these complications of hiring people in other places and creating like new types of shares and all of that?
I think it can be. I think the term I like to use, cost of compliance. Right. So you just need to consider like what are you trying to do? I'm just trying to hire like one or two people and incentivize them with fairly, insignificant amounts potentially. Right. So is it worth going through all the hassle to, engaging advisors, doing documentation as well? And do those individuals actually want to receive equity? Maybe they'll be super happy with just getting a little bit more cash. So that sounds like what makes sense for the individuals, makes sense for the company. Sometimes it may be not worth it going through all the hassle. But look, there's a lot of founders who have like a pretty strong view. So it's like, hey, like, the philosophy that I have is I want every employee to act as an owner. So we want to be aligned. So that's why employee ownership is very important to me as a founder. So that makes perfect sense, but you might need to be prepared of going the extra mile to understand what it actually means. Right? And I think the common, approach is that when jurisdictions, moving money in and out or securities registration is too tricky, that phantom plans can be a good alternative because the way they're designed effectively is you can think of like a fake option plan. You're actually never going to receive the shares, right? But you're going to receive a value if you were to receive the shares and sell them immediately. So effectively, from all practical purposes, it's like a paying a bonus through payroll. You're effectively receiving additional cash payment, which means this phantom is pretty simple because it's as if you're paying a bonus to individuals, right? So the infrastructure you have with local payroll is enough to facilitate it. And what it means, you just need to consider is like, what would you normally do whenever you pay people an additional sum of cash? And that's kind of your reporting obligations, which is something you're already familiar with because usually every year you may be paying bonus to individuals. So you can use the exact same infrastructure to do that. The way the payouts are calculated will be linked to share price. Mm.
I
Go ahead. Yeah.
I was gonna say, let's say I'm phenomenally successful and
Yep.
that equity becomes worth a ton. It's
Yep.
one thing if I sell the company for, $50 million and, assistant office manager made a, $25,000 equity upside by staying at the company for the
Yep.
last 6 months or something like that, right? But
Mhm.
if, my first engineer at a $10 billion decacorn, stays with me
Yeah.
the whole time, like that might be a fairly significant payment. How do I
Right.
budget that out? Or do I actually hold some shares in the US entity, like effectively for them that I could get the valuation? How do I make that mechanism work if the number becomes really big?
Yeah, correct. So those are usually the trade-offs, right? So the phantom cash settled plans give you flexibility. I don't need to worry about the shares. I don't need to worry about all these rules. But your obligation is ultimately to settle that award in cash. So the question is, where's the cash going to come from? So like nothing in life, there's always a catch, right? So the advantage, like you don't need to deal with all these requirements, but on the flip side is ultimately, usually maybe at the time of exit, you'll need to cash it out. So where's the cash going to come from? So it's a corporate finance decision. Are you going to use your own balance sheet? Is it going to be linked to a fundraise? You're going to use some of the proceeds to, sell the obligation for the employees, right? And also your accounting is a little bit different because ultimately it's like a liability to pay a sum of cash to individual. So yeah, that's, what you've highlighted is a very valid concern. So it could be a good thing short term, but maybe like something you need to prepare for long term. So that's why
Maybe good for
understand.
smaller grant.
Yeah, exactly. It could be. It could be. So for a lot of what we see is like a lot of US companies may have a couple employees maybe sitting in Philippines, Vietnam. So Philippines is very tricky because of securities requirements. Vietnam is really hard from exchange controls perspective. So you can offer phantom to those employees, but offer equity elsewhere. So in a way, this could be like you don't have to do everything in cash or everything in equity. You can specify which instruments or word types you want to use in certain circumstances, depending on, the value of the award or the location of employees as well.
Let's walk through how this actually works from a mechanism perspective. Let's say
Mhm.
I'm a Qapita customer and I say, okay, click a button, equity grant,
Yeah.
Vietnam, right? And this other person in the Philippines. Do you guys build it into your software where something pops up and says, "Hey, by the way, Vietnam, this is a whole task list of stuff you need to do." Is it
Yeah.
more consultative? Like, someone on your team rings me up and says, "Hey, I see on the platform you're trying to offer some shares to somebody in Vietnam. Let's walk through this." Or as a customer, we help create a plan? Or is it more likely that you might have a connection to a lawyer that would sort of help me out? Like, how much is this sort of sit down with a lawyer, and how much is this baked into the right software?
Yeah. I think there's like two parts to it. So within the platform, there's certain workflows that prompt you accordingly. Hey, you're trying to do this. That's how it works. It's enabled, not enabled in those jurisdictions. So there's checks and balances that prevents you from doing something you're not supposed to and also kind of guide you through the process. I think that the other aspect, like the way we approach supporting our customers is that we kind of try to help them along the way. So whenever you set up on a platform, in a way, it's a bit of a review exercise. We go through the paperwork, we sense check, when to send where your employees are, and we provide that guidance. Because a lot of times you may be an expert in your field, but we're experts in equity. That's all we do every day. So everyone in our team understands all aspects of what equity means. It's not just the platform and setup, how to like record your cap table. It's like how to issue equity, what you should do, how things work in different jurisdictions, how is it going to impact your P&L, because everything has to be accounted for. All right. Like what does the valuations mean as well in different countries? You have Section 409 in US. You have other requirements like in India, have to get a separate, valuation. There's a lot of countries in Europe that have specific tax advantage plans. For example, in US, you have incentive stock options that provide you certain benefits if you are, employee in US, UK, France, they have their own tax advantage plans as well. So the way we kind of approach it is yes, software does the heavy lifting in terms of guiding you through and that telling you what you cannot, and can do. And whereas our team is there to kind of support you along the way. At the time of setup, you always have someone to talk to. So if you have questions, so we act as effectively your kind of partner in equity. So anything you want to check, what is from finance angle on your disclosures, reporting obligations, whether it's from HR, when you're thinking about like, hey, I want to do something, how should that work? So we're more than happy to kind of review your plan and tell you, it's like, hey, you might need a sub plan. Your current plan that's drafted works perfectly in countries A, B, and C, but you might need to consider doing something else before you do that. So that's why like we always want to have that open communication channel. Right. So like we always have someone helping you throughout the process on a platform. And obviously you can also engage us and talk to us as well, even before you get started with the administration.
Let's run through a couple of specific countries,
Sure.
because there are obviously countries that people are more likely to do
Yeah.
hiring and not. And so let's just say, you brought up the Philippines, and I might have,
Mhm.
some employees on my team in the Philippines.
Yeah.
Obviously, at least at the headline, the labor cost might be lower, but the complexity
Mhm.
might be higher. High level, what am I looking out for in the Philippines?
So you need to get a local SEC. So we have SEC in US, there's SEC in the Philippines. So you need to apply for an exemption to be able to offer equity. And there's additional reporting and disclosure requirements they have to do every year. What it means in practice, equity is possible. No one really does it. It's just too hard to comply with the local requirements. So that's why Phantom or cash settled awards is preferred by majority of organizations that we work with. So what it means is that if you have your existing stock plan, when you offer options to your employees in US and maybe a few other countries, what you would may want to do, you want to create a separate pure phantom cash settle plan specifically for your employees in Philippines. So the terms of that plan can mimic your existing plan, but ultimately it will have to be a cash settle arrangement. So this is the general practice, and that's a common stumbling block that a lot of our companies have to overcome. So that's why you kind of need to usually set up a separate, phantom arrangement for your employees in Philippines.
Gotcha. Okay, cool. EU. I have, and maybe it's not the same across the EU. Maybe it's different.
Yeah, yeah. So yeah, EU is a pretty fragmented market, and it's quite
Okay.
heavily regulated. But I think a common examples, Germany. Germany was actually very tricky to give equity until a couple of years ago. So what was the common trend is what they used to call VSOP. Actually, it's virtual stock option, which is effectively a phantom option. They actually changed the rules at the start of last year, so now equity is a little bit more friendly. What we see in Europe, actually more and more countries becoming a little bit more friendly from the tax perspective. So the recent changes in Czechia, in Netherlands as well. So when you think about taxation, obviously every government wants to cut, because you
Right.
earn effective income. It's called equity compensation. So it's as if you're getting paid salary, but you're not receiving cash, you're receiving equity. So a lot of cases, the taxing point can be triggered on exercise of your options. So what some of the countries are doing are trying to defer it until potentially sale. So make it a little bit more
So until
friendly
you
to the.
actually have the cash.
Yeah, exactly, right? Because a common tricky point for employees in a lot of countries, and sometimes they don't expect it. Hey, I exercise my options. I work in
Right.
a private company, can't easily just go and sell them
Right.
to
I mean,
anyone.
this is a problem here when you leave
Yeah,
a
correct.
company and
Yeah.
in the US.
Yeah, correct. So for that reason, like a lot of countries, like in a couple countries in Europe, actually been moving towards that more friendly approach to actually incentivize equity compensation in those jurisdictions. But as other, common jurisdictions, UK has had tax advantage plans, which you can think of as like ISO equivalent, EMI, CISO, safe as you earn. So there's a lot of specific arrangements, but they obviously have certain eligibility criteria, so not everyone qualifies them. So what happens? The fallback, you can always do these non-qualified options. You can think of what not qualified, non-qual stock options in US. You can do an equivalent in the UK. France also has a qualified regime that provides quite attractive local plan that you can set up. But once again, it's very tricky to kind of navigate NRH, and it usually causes sometimes a little bit of an admin headache. So a lot of jurisdictions actually have these local regimes that can provide certain benefits to the employees, but you should have to tick a few boxes to be able to offer them. So that's why the cost of compliance is important. So sometimes what the challenge companies face, they want to try to make it as friendly as possible for my employees in every country, but that might require me to do more work, maybe create more sub plans. Or should I just do something generic across everyone? Maybe not go to the full extent of the benefits that can be offered in certain jurisdictions. So that's
Which is also one of the reasons why, I mean, when I've talked to companies that have, hired overseas, typically it always makes sense that, like, if you're going to go down that route because you
yeah,
have these compliance costs up front, is plan on hiring more than one person in that jurisdiction for any number of reasons, right? It's like, one, if you're going to hire a German engineer, you might as well hire two or three for, if nothing else, that person can have a team, right? Then they can have coworkers and maybe they work in the same space
yeah,
and you've got a little bit of a hub. But also, like, if you've done the work on the first employee, obviously it's going to be incrementally easier to hire two, three,
yeah,
four, and so it just tends to make sense that you thinking about this from a longer term perspective. Like, if you think you can hire
yeah,
five in one country and only one in another, maybe build out that hub
yeah.
first.
Yeah, I mean,
Um,
practically that makes sense. But yeah, but you sometimes you just follow the talent and hire wherever you can find them. Which is
for
the trend
sure.
we've been seeing. A lot of companies have smaller teams, but they're more spread out. So definitely a trend we see.
Okay, so let's do two more. India. What
Right.
about if I'm hiring a team in India?
So equity compensation is pretty much bread and butter here. There's been a lot of good case studies, a lot of exits, a lot of liquidity. So employees in India understand and expect equity. Options are the most popular way to do it because it's usually the most flexible. All right. For a couple of things to consider. In US, you have 401(a), which you need to get done before you start granting equity to employees in US to set the strike price. In India, you need to get a merchant bank evaluation for the exercises because it's important for tax. So there's going to be a nuanced requirement for evaluations. For Indian companies, there's a lot of requirements such as what you can or cannot do. So you must have a 1-year cliff and you can't give equity to non-employees as well. So it makes it tricky. If you're a foreign company, you actually have a lot more flexibility, right? But you just need to be mindful about who will be the issuing entity of the equity. Are you going to be doing from your parent, like Delaware C Corp, right? Or are you going to have, a local company that's giving equity away at the Indian level? That will actually trigger slightly different requirements. So your corporate structure is also equally important because you want to understand what's the relationship of the recipient of the equity and the issuing company.
Okay, so actually, so you just threw a complicating factor into this,
Mm,
is that not everybody that I want to grant equity to might actually be an
yep.
employee. So,
Yes.
and now we have this contractor thing, and, like, if I'm using a platform like a Deal or
Mm,
where they've set up entities in other countries where, like, technically the person for payroll purposes is employed by Deal
yep.
or this other entity, can they even hold my company's equity? Can I grant equity to somebody who is not fully employed at the US equity level?
Yeah. So this is a pretty messy area and kind of really depends on, I'll highlight a few factors to consider.
Mhm.
Your plan that you have usually has eligibility criteria. So depending how it's drafted, the plan is drafted, only employees of the group entities are entitled to participate in this plan. Right? So that plan actually restricts you from granting it to anyone else. What usually we see in US, there's usually flexibility to give it to advisors, consultants, so that's usually okay. The second point you made is about the legal employer is actually going to be the EOR, PEO entity, so the local company. So effectively, you're not an employee of that jurisdiction. What that usually, so employee of your company, what that triggers is a little bit of a tricky situation with withholding obligation. So whenever you give away equity, company in every jurisdiction usually has a requirement to withhold and or report. So if you're giving equity to exercise, usually the employer has obligation sometimes to withhold a portion of it to send it to the local tax authority. Right? But if you are giving equity directly to the individual, but they're actually sitting on the payroll of their different entity, it creates a very messy situation in terms of can they actually withhold even though they have no relationship. So the problem actually in this space, it's possible to give equity to EOR and PO in some jurisdictions. In some jurisdictions, it's completely you fly in blind because there's no legislation, it's not very clear. So it depends which advisor you talk to. Some of them may take a conservative approach. You shouldn't be doing this because there's no precedent in the legislation that allows you to do that. Some countries like UK have been making steps to make it a little bit more crystal clear to see what you can or cannot do. But yes, that relationship, that documentation, and then especially the payroll obligations, that can be very tricky. So yeah, that's a common challenge we see from the likes of, Deal, Remote as well. They obviously have their own obligations. So a lot of cases, they may take the conservative approach into like withholding or saying that we cannot support this as well. So it's important to kind of consult your plan rules to see what it allows, talk to your relevant provider to understand their obligations, what they're willing to do as well, and also check if this is allowed or not. Because in some countries, it's not something you can even offer.
Let's talk about moving around from an employee
Mm,
perspective.
yeah.
So, I'm a US employee here. Got granted options like normal. And then, I decide to, follow my spouse, go move to another country or anything along those lines. And so I where am I subject to taxation wise? And are there places that I might move that I wind up getting subject to double?
Yeah, that's possible, right? So the way you can think of it is taxation rules in country A, taxation rules in country B. Moving from A to B may be different than moving B to A. So there's a concept of tax sourcing. So I can use Singapore where I'm at the moment as an example. So from the Singapore perspective, what the tax authority would care about is the income you receive during the course of your employment in Singapore. So if you receive a grant of equity while you work for the Singapore entity, then you move to the US. On the way out, Singapore will be like, okay, let's just break off our relationship. There'll be effectively a tax trigger on your exit from the country. For a lot of countries, it's usually done on a pro rata basis, right? For Singapore, it's a bit of an all or nothing approach. Either we're going to tax you on everything or we're going to tax you on nothing if that equity is received outside of your time in Singapore. So for US employees moving overseas, you may have like this a trailing obligation from the tax perspective. And even if you don't move overseas, moving from one state to the other also can actually trigger different requirements. As we all know, there's different state tax that applies. So yes, it can be a very messy situation. And there could be some jurisdictions when you effectively get taxed on the way out and also get taxed on the way in. So that one you need to also look in if there's any treaties before those jurisdictions to see if there's double taxation can be avoided.
Thing that my first signal that might be my software platform, like my equity platform, like Qapita would pop that out or give me a warning or just let me know that this
Yeah,
might be more complicated than I think.
yeah, it's definitely going to be more complicated than you think. I think the one key takeaway I can suggest is, especially for the companies looking to bring in talent from overseas, is Section 409 is the one thing you always need to remember. So in US, you always have to give options at the strike price. In a lot of other jurisdictions, there's no such rule, so sometimes you give discounted option. But as soon as you move to the US, those requirements trigger, and some of the awards that you might have been granting to the employees outside of the US all of a sudden become non-compliant from the US perspective. So yes, like the key recommendation that we have for our clients is do a bit of planning. understand where your employees are at the moment and potential movements. So whenever we kind of do this entire review setup, we always ask those questions. Okay, where are your employees now? Who you think you've given equity? Do you expect people to move around? Because sometimes it's not even a relocation, it's even going on an assignment for a period of time. So those can trigger those specific requirements. So there's
Gotcha.
the entire industry focusing mobility, and yeah, it can get very complex.
Cool. Well, listen, this is all super helpful. A little bit overwhelming given
Yeah.
the amount of things that I feel like a founder would need to know when running a global company. One piece of advice I give people, and I've experienced myself, is whatever you're doing, work with people who
Yeah.
do that thing all the time. And that
Yeah.
it's like saved me countless amounts hours of administrative overhead. Is, if you are building a company that is going to have employees across multiple jurisdictions, make sure the partners you work with companies like that all the time as their
Yeah.
main kind of thing, I think is the really key takeaway for this. So obviously that's what you guys do, and really appreciate you sharing all your knowledge about this.
Yeah. No, thanks, Charlie. And obviously, like anyone listening, like we're always happy to chat and help you out. Cause I guess like, yeah, the recommendation, yeah, you need to think about the company, but you also need to think about the employees. The last thing you want is for them to get a surprise tax bill and have this our note like when they're leaving the company is like, hey, I think they tried to screw me over. They didn't tell me about this, right? No one wants this as well. So I think doing a bit of homework and then seeking help, definitely something we're happy to offer. So if anyone has questions, we've seen many cases of people moving around or setting this up or hiring different locations. So we're happy to provide the guidance.
Cool. Well, thanks so much for your time. And for you, enjoy the rest of your evening.
Thanks, Charlie. Have a good
All
one.
right. Thank you. Bye bye.